Hello, everyone, and welcome to The Buck Stops Here. I'm Catherine Murray. Well, we are wrapping up 2022, and I do pre-tape this. It is Friday, December the 16th, and it's been a very difficult time in the market this week. We have seen some major sell-offs. We had a nice rally to start the week, and then, of course, we had the U.S. Federal Reserve make comments on Wednesday, really indicating that they are not going to stop or put a pause or a pivot in terms of rate hikes. So we've seen a lot of volatility in the market. I wanted to get perspective in terms of what we're seeing right now, but more importantly, what do we see in 2023 and how do we position ourselves? So for that, I am bringing in Hugh Johnson, a veteran on Wall Street, and he is the chief economist of Hugh Johnson Economics. Hugh, great to be able to be with you today. Thanks so much for joining us.
I'm happy to be with you, Catherine, as always.
Thank you. I just mentioned it has been very volatile this week. There's no doubt about it, and it really has been the entire year. Why don't we first start with your interpretation of the Fed? Obviously, the market is selling off with concerns, but it's interesting because the 2-year, which they're controlling, is high, but you're seeing the rest of the market say not so fast. We don't see high rates in the future.
Catherine, it's a little bit confusing, and I'll say why it's confusing. Because you're absolutely right on your introduction, which was to simply say that the Federal Reserve has made it very clear that they're going to continue to raise interest rates. And actually, they've been somewhat specific on how much they're going to raise interest rates in 2023. I think you can reasonably expect that we're going to see 75 basis points. That might be 50 in February and 25 in March, or maybe it'll be 325s. But I think that's what we have. We're going to start to see, or they're going to continue to raise interest rates. And then you compare that with the so-called dot plot, which really reflects the views of the members of the Open Market Committee as to what they see lying ahead. And the numbers are really a little bit troubling. And the numbers really simply say that economic growth is going to continue to slow. They're talking about 0.5% growth in 2023. They're also talking about at the same time that the unemployment rate will go up to 4.4, 4.6%. It's hard to say that that's not a recession. They don't want to call it a recession, but they say it's not a recession. But if you get 0.5% growth in the economy, it's hard to say that you're not going to get a couple of quarters of negative GDP. And of course, if you get an increase in the unemployment rate to 4.4, 4.5%, as they're suggesting, it's hard to reconcile that with there not being two negative GDPs. But at the same time that you're going to get that, they're going to be continuing to raise interest rates. So there's a little bit of a disconnect in what we heard from the Federal Reserve. They're going to continue to raise interest rates. The economy is going to not do as well as it did in 2022, even though it didn't do that well in 2022. The rate of inflation is going to come down, but the Federal Reserve is going to stick to its guns. They're going to continue to raise interest rates until March, and then they're going to stop and hold the line for the remainder of the year. I'm pretty sure that's what they're telling us.
And I think that's what you're seeing in the long end of the yield curve, right?
You're seeing that in the long end of the yield curve in a lot of their places. I think, when you take a look at the long end of the yield curve and compare it to the short end of the yield curve, as I'm sure you're well aware, Catherine, we have an inverted yield curve. If you take the history where long-term interest rates are lower than short-term interest rates, a reflection that, basically investors are saying the Fed's going to be successful in reducing inflation. They're going to likely to be successful in reducing inflation because the economy is going to slow, maybe more than any of us would want. They're going to be successful, and that's why longer rates are coming down, even though shorter rates are not as yet coming down. That's why you have a inverted yield curve. And that's one of the reasons why so many investors conclude, quite rightly, that we're likely to have two negative quarters of GDP in 2023 or a recession, even though not a very severe recession.
One of the things that I find troubling is that the only way, after printing money for essentially a decade, whether it was the Fed or any other central bank around the world, that was after the financial crisis. And then, of course, COVID, we needed that help in many, many ways. But all of this printing of money, boosting up incomes, boosting up lifestyles, et cetera, and now and therefore causing inflation. And the only way they can combat that is to cause a recession. And the issue I have with it is that there's going to be a lot of people who are really going to feel the pain by not having jobs anymore. You're seeing layoffs across the board, and also home prices decline and higher interest rates that they probably can't afford. Before we even get into investing and how to best position yourself, I mean, from an economic perspective, how do you think people should be positioning themselves?
You said all the right things, Catherine, and I guess I would use the word that we've gone to extremes. I'd also be so blunt as to say the Federal Reserve, primarily the Federal Reserve, but also the federal government of Washington has made mistakes. And you're absolutely right that this is a money phenomena, and the buildup or the increase in the money supply based on the Federal Reserve increasing the size of its balance sheet, in other words, holdings of financial assets, based on the federal government spending so much money to try to get us out of the pandemic or to help us during the pandemic. The money supply increased $6 trillion. And that led to, of course, the increase in inflation to 4.7% in 2021 and now 8.1% in 2022. And now they're going in the other direction. Again, the word extreme, word mistake also occurs. And we're talking about a Federal Reserve now that's reducing the size of its balance sheet. We're talking about a federal government in Washington that is slowing the growth of its spending. And as a result, we're getting numbers on inflation now. Yes, they're coming down 4.7 to 8.1, and it'll probably be 3.5% and then 2.5%. But we're going to get high rates of inflation and high rates of unemployment. And you're right, there's going to be a lot of pain. And obviously, Powell knows there's going to be a lot of pain, and he warned us that there's going to be a lot of pain. That's an unfortunate outcome of what I think are just some mistakes in monetary and fiscal policy, and it's really unfortunate.
It is really unfortunate. With respect to, and it's interesting, I'm going to segue for 1 second here. If you really think about it and what we're talking about in terms of monetary policy impacting all of us in extreme ways, really, that is the genesis for cryptocurrencies. It was the genesis for Bitcoin, to not have central banks determine the value of your currency, correct?
Well, it is, but don't forget that if they did it right, and they didn't do it right, in my judgment, they went too far. But the problem with crypto is that yes, it takes the growth of the money supply, it takes the level of the money supply away from central banks. That's not a good outcome. And the reason that's not a good outcome, if they did not make mistakes, they would have increased the size of the money supply in order to help us out of the pandemic, but they'd increase it by the right amount. That's not easy. Monetary policy is an art. It's not a science. But they would have done it right. And also, on the other side of the equation, when they're starting to slow the economy by reducing the growth rate of the money supply, they do it a little bit more with a little more finesse. So the point is the one problem with crypto is you take it away from central banks, which takes it away from the ability of central banks to have an impact on the economy. And that's a big mistake. And that's going to come to an end. You're not going to have crypto being the currency, whether it's depending on the crypto you're talking about. It's going to still be in the hands of the central bank, and they will come up with their own answer to crypto.
Right, their own digital currency. You're seeing that in various central banks around the world doing pilot programs for sure. But while we're on it in this segment, let me get your take, and we're going to talk about investing in other areas. But Hugh, you're a Wall Street veteran, sensible person, I think, in all these years, of course, that I've been in interviewing you. What's your take on FTX and Sam Bankman-Fried? I want to ask everybody I talk to.
Let me put it briefly. I've been warning about crypto. I've been warning about Bitcoin. I've been warning about a lot of other things where there's clear cases of speculation. There are no fundamentals. There's clear cases of speculation. There's no fiat currency being created. It's not going to be the case that people are going to accept crypto. In some cases they will, but in most cases they won't, in payment for any services. It just makes no mistake. It's pure speculation. When you get pure speculation, you're going to get distress. When you get distress, what happens is a lot of those that have borrowed money to buy, whether it's crypto or any other speculative asset, are going to have trouble making their debt service payments and are not going to make them, and they're going to default. And that's followed by revulsion. And revulsion is when we get a very sharp decline in prices. That's what you're seeing right now. And let's not forget the one other thing that's characteristic of these kinds of outbreaks of speculation, and that's swindles. And the urge to swindle and the urge to be swindled runs parallel to the urge to speculate. So this is a pure and simple mania, and it's now ending, and it should have.
Okay, we'll take a quick break. We'll be right back.
What it leads to, of course, is when you have speculations followed by distress where people have trouble making their debt service payments, some do not in default. We've had a lot of that in crypto. We've had a lot of that in FTX. That's a perfect example of it, which is followed or accompanied by a decline in prices. That's called revulsion. And when we have a decline in prices, one of the things that makes that decline even worse than you would have expected is the emergence of or the revelation of the swindles. And as what I said, which is important, is that the urge to swindle and the urge to be swindled, think about it, the urge to swindle and to be swindled runs parallel to the urge to speculate. You don't get speculation unless you get swindles. And this is just simply a clear case of where we've had speculation, we've had bankruptcies in the distress period, we've had the decline in prices in the revulsion period, and there was swindles all along the way. It's a perfect example of a mania, the kind of mania that we saw in tulips in 1907 in New York City. We've had it continuously and will continue to have it. It's really unfortunate.
And interestingly, you actually gave a speech about this 4 or 5 years ago.
I did. I gave a speech and I said, look, crypto is speculative. And the only thing I finished with was, look, irrational speculation is invariably going to be followed by rational regulation. And that's exactly what's going to happen in the next year or two. If the federal government in Washington gets around to rational regulation of crypto, and it's not going to be just the federal government, the Federal Reserve will have to become part of it because they're going to have to kind of create their own crypto or a currency which has a level of confidence that in some cases, unjustifiably, crypto has.
Yeah. But I love that you gave this speech to about 500 people 4 to 5 years ago, and probably nobody really cared. What do you think?
Maybe two. Maybe know. 2 people. What? Maybe 2 people listen. And if 2 people listen and avoided getting caught up in that speculation, gosh, I hope there were more, then I think that it was successful. But there certainly weren't enough because there was too much speculation in crypto. And now everybody sees exactly what we're talking about.
Yeah, they do. All right. So outside of crypto, well, we're not investing in crypto. That's not our conversation today. But where do you want to be positioned? Let's talk about that. Right now, where do you want to be positioned? It's still 2022. As I said, we pre-taped this on December the 16th. But where are you today?
That's a great question. And let me just say something important. And that is, I've looked at the 25 bear markets that have been accompanied by recessions since 1890. And of the 25, 23 of them have ended during a hard landing, during a recession. I think we're headed towards that hard landing or recession, the first and second quarters, and we'll get a turn in things. First thing we'll see is a turn in Federal Reserve policy. They'll start to take their foot off the brake. That's coming, Catherine. When they take their foot off the brake, and it might be coming as a surprise, you might see that as early as March, but I don't think so. I think it's probably going to wait a little bit, but you'll see signs that they're going to take their foot off the brake. Then you'll see signs that the economy is going to turn for the better, that the recession in the first 2 quarters is going to end. And when you start to see that, the stock market's going to do better. So for now, you got to play it defensive. You still have to have a defensive portfolio. You got to reduce or keep a fairly low allocation to equities. But believe me, in the first or second quarter, when we start to get the hard landing, when you get those numbers, when you get numbers that are pointing to a recovery from the hard landing, that's when the stock market's going to turn for the better, and we're going to start a new bull market. So The later part of 2023, I think will be better. It won't be great, but it'll be better. And that's when you want to shift
Hmm.
portfolios from defense to offense.
Hmm. With respect to having a low allocation towards equities, I mean, Hugh, a lot of people aren't traders, myself included. I'm much more of an
Mhm.
investor versus a trader. Um, it's difficult to make those changes, right? So,
Oh,
you
yes.
know, what's the right process just to kind of trim your profits and then sell your losers, or how do you go about doing that?
That's a great question because a lot of our clients have big gains from the bull market that we did have, and they're stuck.
Yeah.
They can't sell because they don't want to take the gains because they don't want to pay the tax, and I don't blame them. So you really kind of got to. There are ways to sort of hedge around that, but nevertheless, you probably got to hold on and just go with it, because
Hmm.
Catherine, the most important thing I think I ever heard said was it's time, not timing, that's the secret to success in the financial business. And that means, keep a meaningful allocation to equities. Now, if you don't have a meaningful allocation to equities, because we're going to come out of this, as I mentioned, first or
Hmm.
second quarter. If you don't have it,
Wait,
then you can
Hugh?
sort of stage or dollar cost average your way in. And you understand what I'm talking about.
So, Hugh, I just want to pick up on something you said, which I have not actually heard in all of my years, which is that investing is time, not timing. What do you mean by that?
I mean, it's time, not timing, that's the secret to success. In other words, if you try to time the markets, it's the when the bottom is going to be in this bear market and when a bull market's going to start, you're not going to get it right. It's very hard to do. The only thing I can advise is to say that, look, at bear markets end and bull markets start in hard landings. That's history back to 1890. So the fact that we're going to have a hard landing or a little bit of a recession in the first and second quarter, which is my forecast, and I might add the Federal Reserve's implicit forecast, that's not bad news. That's good news because that will set up, in my judgment, the end of the bear market, start of a bull market, and that we'll have a better second half of 2023 than a first half. In other words, we'll get past this bear market.
Hmm. And how do you want to then be positioned for the bull market? Where do you see the opportunities? I mean, is it your traditional bull market and go for the growth companies,
Yeah.
or, yeah?
Oh, yes, Catherine. Keep in mind history again, and keep in mind that small capitalization stocks outperform large in the early stages of a new bull market. That's one thing not to miss. The other thing is, of course, you have
Hmm.
consumer discretionary technology, industrial stocks, and we're starting to see some of those stocks do a little bit better on a relative basis right now. Those are the things that are going to work at the beginning stages of a new bull market. But keep in mind, if you have a healthy portfolio of equities right now, don't do a lot about it. You're going to be just fine. I'm really talking to the person who's really short, doesn't have much equities in all, and you want to sort of stage in. You want to add equities to your portfolio. Want to do it in a sort of a dollar cost averaging style over the first two quarters as we get to that point when the
Hmm.
bear market ends and a bull market begins. And I say that I don't know if that's going to be the outcome, but I say that with my fingers crossed, and I'm very hopeful.
Fingers crossed for sure. It was suggested to me as well that when we look back to the 70s and what Paul Volcker did by raising rates to such a degree and causing so much havoc within the marketplace, within the markets, that did set up for a very long bull market. Is that
Sure
what
did.
you're also perhaps suggesting or seeing here?
Just one of the many examples of exactly what I'm talking about. Paul Volcker created a recession in order to bring inflation down. That's exactly what they're trying to do right now. And when they finally did create the recession, remember there were two. There was one in early 80 and then in 82. And when we had the turn in August of 82, we had a bull market that lasted for a long time. That's precisely what's going to happen this time. You're going to have the economy is going to have a hard landing. It's going to be accompanied by
Mm-hmm.
a decline in inflation. We're already seeing the start of that decline in inflation. And at some point, the Federal Reserve is going to get the message and they're going to turn policy. And we're going to start to see them talking about lowering interest rates, not raising interest rates. And there'll be signs like the index of leading economic indicators that are going to say that it's going to work. All the same kind of stuff that Volcker faced, all the same kind of outcome that Volcker accompanied in 1980, 81, and 82, and it'll be setting the stage for a much more positive equity market environment.
Let's hope so. Less volatility, more, maybe a little bit more predictability. I mean, I know people
Yes.
who were in the hedge fund business who were, top of the game, and they said, like, look, this is just, a market that's completely driven by monetary policy. How can you really have long, short positions and what have you? So they actually exited. I know people who exited the business because you can do it the way
Well,
you've always been trained to do it.
you're hitting the nails on the head, Catherine, continuously, and that's exactly what they're talking about. Monetary policy, as it did in 1980, 81, 82, really was driving decisions on the equity market, and that's going to continue to be the case. But you're going to see a shift in 23. In other words, the shift you're going to see is, first of all, Federal Reserve policy is going to be talking about taking their foot off the brake, and the second thing is there's going to be a lot more attention or focus on China, Ukraine, Europe, the UK, and some of those really big issues that are going to change, and earnings. Earnings are going to be extremely important. Some of those big issues are going to really matter more than monetary policy in the latter part of 23.
Good point. Good point. I only have about 20 seconds left, Hugh, but I have to ask, thoughts on oil. Even though we're looking to own growth stocks going forward, do you still own oil, just given the supply-demand dynamics?
You can own oil. Oil is going to be stable around $80 to $85 a barrel, but we're going to have a lot of volatility. There's volatility when it comes to oil, so hang on to your hat. You can own it, but hang on.
Okay, we'll leave it there. Great to see you. Thank you so much. Happy holidays and Merry Christmas, Hugh.